Banks spent years treating stablecoins like a strange corner of crypto. Now they are launching tokenized dollars, partnering with stablecoin companies, and fighting over the rules. Why the sudden interest? Because stablecoins are no longer just chips for crypto trading. They are beginning to compete with two of the most valuable things banks control: customer deposits and the rails that move money. The threat is not that everyone will abandon banks tomorrow. It is that money could start moving through a new system while banks lose the deposits, fees, and customer relationships attached to the old one. To understand the fight, forget crypto prices for a moment. A conventional dollar stablecoin is supposed to work like a transferable receipt. You give an issuer $1, the issuer creates one digital token and holds reserve assets behind it. You can send that token across a blockchain, and an eligible holder can eventually redeem it for $1. But that token is not literally a dollar sitting inside the blockchain. It is a claim issued by a private company. Its reliability depends on the quality of the reserves, the redemption system, the banks and custodians holding those reserves, and the software moving the token. That makes a stablecoin look similar to a bank deposit. But the plumbing is different. When you place money in a bank account, the deposit becomes a liability of the bank. The bank does not normally leave every dollar untouched in a box. It holds liquid assets, maintains required safeguards, and uses part of its funding to support loans and other assets. Eligible deposits also receive federal insurance up to legal limits. A payment stablecoin is designed differently. Its issuer is generally expected to hold highly liquid reserves against the tokens, rather than use that money to make ordinary mortgages or business loans. Stablecoins are also not automatically covered by deposit insurance, just because some of their reserves sit at a bank. So why did this become urgent now? One reason is regulatory clarity. On July 18, 2025, the Genius Act became United States law. It created a federal framework for permitted payment stablecoin issuers, including one-to-one backing with specified liquid assets, reserve disclosures, redemption policies, and regulatory supervision. That did not remove every legal or operational question. Rulemaking and political disputes continued through 2026, but it changed the conversation. Stablecoins were no longer something major financial institutions could dismiss as legally undefined experimental money. At the same time, payment companies started building them into real infrastructure. MasterCard expanded stablecoin settlement options in 2026, with banks and payment firms expected among the early participants. Visa introduced an enterprise platform that lets financial institutions access wallets and manage the minting, movement, and redemption of stablecoins. That is a much bigger signal than a shop accepting a crypto token. This is stablecoin technology entering the settlement layer behind familiar financial products. If you enjoy explanations of the hidden systems moving money and technology, subscribe. We focus on what the machinery actually does, not just the headlines around it. The payment argument is easy to see. Banks and payment companies operate globally, but much of the underlying financial system still has business hours, cutoff times, separate databases, and chains of intermediaries. A cross-border transfer may pass through correspondent banks that handle messaging, compliance, currency conversion, and settlement. A stablecoin can shorten part of that chain. Once two participants already have compatible wallets and access to the same token, value can move directly between them on a shared ledger. The transfer can happen outside normal banking hours, and software can automatically connect it to an invoice, delivery event, or treasury rule. Imagine a company in the United States paying a supplier abroad. Instead of sending instructions through several institutions, it may send a dollar stablecoin to the supplier or the supplier's payment provider. That provider can then convert it into local currency. This does not magically eliminate foreign exchange costs, identity checks, sanction screening, taxes, fraud controls, or the need to connect back to local bank accounts. The blockchain leg may settle quickly, while the conversion at either end remains slow or expensive. That is one of the biggest misunderstandings in this debate. A fast token transfer is not the same thing as a complete, safe, consumer-friendly payment system. Traditional card and bank networks include dispute handling, account recovery, fraud monitoring, and legal responsibility. Stablecoin systems still need their own versions of those layers. Even so, the new rail matters. If businesses can move money around the clock with fewer intermediaries, banks risk losing payment fees and visibility into their customers' financial activity. Payments are also a doorway into other services. A company that handles your payroll, supplier payments, and cash management has a strong position from which to sell credit and investment products. Then there is the more sensitive issue: deposits. Deposits are not just numbers banks store for customers. They are an important source of funding. Retail deposits can be relatively stable and inexpensive compared with borrowing from wholesale markets. Now imagine moving $10,000 from a bank account into stablecoins. The stablecoin issuer receives the money and must place the reserves somewhere. If it holds the full amount as deposits at another bank, the money may not leave the banking system. It is mostly moved and become concentrated in the issuer's reserve accounts. But if the issuer uses the money to buy short-term Treasury securities, the original bank has lost a deposit. If this happens at large scale, some banks may need to compete by paying higher deposit rates, borrow from more expensive sources, or reduce certain kinds of lending. The outcome depends on where stablecoin reserves are held, which customers adopt them, and how banks respond. That is why dramatic claims that stablecoins will either destroy bank lending or have no effect at all should be treated carefully. The fiercest conflict is over rewards. Stablecoin issuers can earn interest from the treasury bills and other reserve assets backing their tokens. That reserve income is a major part of the business model. Normally, the token holder does not automatically receive it, but an exchange, wallet, or partner may offer rewards to people who keep stablecoins on its platform. To a customer, that can begin to feel like an interest-bearing cash account. Banks argue that this creates a deposit competitor without the same capital rules, deposit insurance obligations, lending role, or full regulatory structure as a bank. Crypto companies answer that banks are trying to protect cheap deposits from competition and prevent customers from receiving more of the value generated by their money. Both sides have obvious economic incentives. Banks want to protect their funding. Stablecoin companies and exchanges want stablecoin balances to become useful places to store money, not just temporary tools for making payments. This explains why banks can resist stablecoins and adopt them at the same time. A bank has several possible responses. It can hold reserves for an outside issuer. It can provide custody and compliance services. It can connect stablecoins to customer accounts. It can issue a stablecoin through a permitted structure, or it can build a related product called a tokenized deposit. A tokenized deposit is a digital representation of money deposited at a bank. JP Morgan's JPM coin, also known by the ticker JPMD for its dollar deposit token, is an institutional example. The difference sounds minor, but matters. A stablecoin is a claim on a stablecoin issuer, backed by a reserve pool. A tokenized deposit remains a claim on a particular bank and operates as commercial bank money. Banks like this model because it keeps the deposit, the customer, and the compliance relationship inside banking. Customers may like the familiar legal framework and the potential protections associated with a bank account, but tokenized deposits can be less portable. A token tied to one bank may not move freely across every wallet, exchange, or blockchain application. Stablecoins gained usefulness partly because many unrelated platforms agreed to recognize the same tokens. So the competition is not simply old banks against new crypto firms. It is also a contest between different forms of digital dollars. One form tries to make a private reserve-backed token widely portable. Another tries to give existing bank deposits the speed and programmability associated with blockchain networks. There are still serious risks. A stablecoin can lose its peg if users doubt the reserves or cannot redeem quickly. In 2023, USDC briefly traded below $1 after Circle disclosed that part of its cash reserves was held at the failed Silicon Valley Bank. The reserves were later made available, but the episode showed that a token can inherit risks from traditional banking even while operating on a blockchain. There are also software failures, stolen wallet credentials, network congestion, frozen addresses, compliance disputes, and concentration around a small number of issuers. One-to-one backing can reduce risk, but it does not make every part of the system risk-free. The most likely result is not a clean victory for banks or stablecoin companies. It is a hybrid system. Banks may provide the accounts, compliance, liquidity, and conversion services. Stablecoin issuers may provide widely accepted digital tokens. Blockchains may handle part of the settlement. Card networks and fintech apps may hide all of it behind interfaces people already understand. The customer might never know which rail was used. They may only notice that a payment arrived on Sunday instead of Tuesday. That is why banks suddenly care about stablecoins. Stablecoins challenge the old assumption that payments, deposits, and banking must always arrive as one package. They separate the movement of money from the institutions that traditionally held it. And once that separation becomes practical, banks have two choices: defend the old bundle or rebuild themselves for the new rail. If you have a question about stablecoins, tokenized deposits, or digital payments, leave it in the comments and tell us which piece of financial technology we should unpack next.